am Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar Conference, and I'm here with Karen Schenone, who's a fixed income strategist at iShares BlackRock. Great to see you, Karen.
Thanks for having me, Tom.
A lot of discussion about income, a lot of discussion about rates. So for the average advisor, if we've got a couple minutes to kind of get into their brain a little bit, what do we need to tell them that they need to be thinking about?
Yeah, I think a lot of advisors are concerned about portfolio construction. How do my fixed income assets interact with my equity assets? So what we're seeing right now is a lot of advisors were short duration the last couple of years. They're adding it back to the portfolios. And I think one of the more efficient ways to do that in this market is to think about adding it through investment grade credit rather than treasuries, because it is going to come with a little bit of extra income and the risks are marginal compared to treasuries at this point.
So most will benchmark to the Barclays Agg. Barclays Agg has changed a lot in the last 9 years. We're seeing longer duration, we're seeing more credit risk. So what are advisors needing to talk to their clients about as far as maybe getting away from some of these risks?
Yeah, I think what they need to really think about is how conservative are they going to be, what kind of risks are they willing to take, and what their asset allocation should be. I still think the Bloomberg Barclays aggregate really stands the test of time as being that benchmark that is going to benefit from that flight to quality. However, if they do need more income, maybe they can look at benchmarking to something like the Barclays Universal that is going to have high yield and emerging market debt and have a little bit more income and actually less volatility over time.
What about global fixed income opportunities?
Yeah, I think a lot of people have avoided global fixed income for the currency risk. So we're seeing people implement that either through currency hedge strategies, or maybe now they're willing to take on the local currency because they think the dollar could be a bit weaker going forward.
Talk a little bit about corporates and high yields. There have been a lot of periods in the past where even times of rising rates, they've done okay.
Yeah, I think that's one of the things that we notice. Whenever there's growth in the economy and rates rise as a result of that, basically to combat the inflation, we see that's great for credit risk. We see credit spreads tightening in, and you'll see high yield and investment grade outperform other categories.
Yeah. So as advisors, we've been kind of taught to prepare for a rising rate environment for the last 4 or 5 years. Is it finally coming? Is it finally here?
Well, we're 3 hikes into the cycle, so I think in some ways it's already here. I think everyone's looking forward to if the Fed starts tapering their balance sheet, what is that going to mean? Yeah. But we're still seeing all this foreign demand for U.S. fixed income securities, kind of keeping a lid on rising rates. So we think they might drift a little higher, but we're not going to go back to 6, 7, 8% yields anytime soon.
Right. And then finally, iShares continues to provide more tools in the fixed income area. Might we be seeing more from iShares in the coming years as well?
Definitely. I think we're thinking about more outcome-oriented strategies. How can we help advisors achieve a single goal through the ETF? Right now we offer a full spectrum and basically building blocks, and we're trying to think through the next evolution of products and how can we help advisors achieve their goals more efficiently.
Excellent. Karen, great seeing you.
Thanks, Tom.
Thank you.